Welcome to CoreLogic's housing market update for April 2022, brought to you by onthehouse.com.au. Nationally, housing values are up 0.7% in March, a subtle increase on the 0.6% lift recorded in February. The uptick in the monthly rate of growth was primarily driven by the stronger conditions in Brisbane, Adelaide, Perth and the ACT, along with several of the regional areas, offsetting a slip in values across Sydney and Melbourne. The first quarter of the year has seen Australian dwelling values rise by 2.4%, adding approximately $17,000 to the value of an Australian dwelling. To put the latest growth into some context, a year ago, values were rising at more than double the current pace, up 5.8%, before the quarterly rate of growth peaked at 7% over the 3 months ending May of 2021. Sydney's growth rate is showing the most significant slowdown, falling from a peak of 9.3% in the 3 months to May 2021 to 0.3% in the first quarter of 2022. Melbourne's housing market has seen the quarterly rate of growth slow from 5.8% in April last year to just 0.1% over the past 3 months. While the monthly rate of growth was up among most cities and regions, there is mounting evidence that housing growth rates are losing some momentum. Virtually every capital city and major rest of state region has moved through a peak in the trend rate of growth sometime last year or earlier this year. There are some exceptions to the slowdown, with regional South Australia recording a new cyclical high over the March quarter and some momentum returning to the Perth market, where the rate of growth is once again trending higher since WA reopened its borders. With the softening in market conditions, the national annual growth rate of 18.2% has fallen below the 20% mark for the first time since August last year, after reaching a cyclical high of 22.4% in January. We're expecting the annual growth trend will fall sharply in the coming months as the strong gains recorded in early 2021 drop out of the 12-month calculation. National housing turnover is also easing, with preliminary transaction estimates for the March quarter tracking 14% lower than the same period in 2021, but still 12% above the previous 5-year average. Nationally, the volume of housing sales is coming off record highs, but there is some diversity across the capital cities in these figures as well. Our estimates of sales activity through the March quarter is 39% lower than a year ago in Sydney and 27% lower in Melbourne, while the stronger markets, like Brisbane and Adelaide, have recorded a rise in sales over the same period. Regional Australia continues to show some resilience to a slowdown, with housing values across the combined regional areas rising at more than 3 times the pace of the combined capital cities through the March quarter. Regional dwelling values increased by 5.1% in the 3 months to March, compared with the 1.5% increase recorded across the combined capital cities. The rolling quarterly growth trend in regional dwelling values has consistently held above the 5% mark since February of 2021. Adelaide housing values rose another 1.9% in March, taking the median dwelling value to approximately $603,000. The monthly rise was the second highest gain of any capital city after Brisbane. Annually, home values are up 26.3%, adding roughly $125,000 to the value of a typical dwelling over the year. One of the key factors pushing up prices is the ongoing shortage of advertised supply. Total advertised listings are more than 40% below the previous 5-year average, while total sales were estimated to be 53% above the previous 5-year average through the first quarter of the year. Part of the attractiveness of Adelaide is the relatively low housing prices. With a median house value of $658,000, Adelaide values are $745,000 lower relative to Sydney and $340,000 lower than Melbourne. The housing market has transitioned from an upswing generally characterised by strong and broad-based rises across the regions of Australia to one best described as multi-speed. At one end of the spectrum are Australia's 2 largest cities, Sydney and Melbourne, which are recording flat to falling housing values, while at the other is Brisbane and Adelaide, where the quarterly pace of growth continues to rise at an annualised pace of more than 20%. Perth too is re-accelerating off a low base, which can at least partially be attributed to state borders reopening along with strong labour market conditions, and regional markets are mostly strong as population growth runs up against low available supply levels. Despite the diversity, the outlook for housing remains skewed to the downside. Rising fixed-term mortgage rates and the prospect of higher variable mortgage rates later this year are only part of the reason why housing markets are likely to soften further as 2022 progresses. Other factors include worsening housing affordability, higher costs of living, higher supply levels, and lower consumer sentiment. With housing values rising so much more than incomes over the past 2 years, it's become harder for prospective buyers to access the market. The ratio of housing values to household incomes is at record highs across most of the capitals. Saving for a deposit and funding transactional costs is a significant hurdle for a growing number of prospective buyers. Higher costs of living are also likely to weigh on housing demand. Higher inflation implies less disposable income and lower household savings, which could make it harder for prospective buyers to raise a deposit and to demonstrate their ability to service a new loan commitment. A surge in household savings through the pandemic has been a supporting factor for housing demand. However, as the economy returns to the new normal, households are saving less, a trend that's likely to become more pronounced through the year. On the supply front, both newly constructed dwellings and a rise in advertised listings is likely to gradually skew housing market conditions back in favour of buyers, providing more choice and an opportunity to negotiate with less urgency around decision-making. Consumer confidence has taken a turn for the worse over recent months, with measures of sentiment falling to the lowest level in about 18 months. Historically, consumer sentiment and housing market activity have shown a close relationship. Below average sentiment, along with slowing housing markets and the prospect of rising interest rates, is likely to cause prospective buyers to think twice before engaging with the housing market. However, there are other factors that should help to offset the downside risk. A strengthening economy, low jobless rate, and rising income growth should help to keep a floor under housing demand and keep the number of distressed listings to a minimum through a downturn. A new round of incentives for first home buyers is another factor likely to support demand. In the lead up to the federal election, both of the major political parties have announced additional support for first home buyers in the form of an extension to low deposit home loan guarantees. Historically, first home buyers have reacted positively to stimulus measures. Additionally, higher overseas migration is a net positive for housing demand. The most immediate flow-through is likely to be seen in higher rental demand, which could incentivize investors, and in the longer term, flow through to purchasing demand from permanent migrants. With a federal election around the corner, we could see additional announcements relative to housing markets, and upcoming updates on inflation, on labour markets, and wages growth will provide some guidance about the timing of interest rate decisions. The CoreLogic research team will be keeping a close eye on the changing environment and what it means for housing markets via our research available at corelogic.com.au.